Good afternoon and a warm welcome to everyone joining us today for our webinar on MyCPE. My name is Jim and I'll be a host for this session. I'm joining you from Houston, Texas. Before we begin, I hope everyone is staying safe and healthy. As we get started, please take a moment to ensure your audio and video are working properly. You should be able to see the screen and hear me loud and clear. If you experience any technical difficulties, please let us know in the chat or questions panel, or reach out to us at support@my-cpe.com. We are excited to have attendees from all over the world, so please take a moment to introduce yourself and let us know where you are joining us from. Whether it's a city, state, or country, or any part of the world, you're most welcome to MyCPE webinars. Thank you everyone for joining us today. I'd also like to take a moment to thank everyone for joining us today and supporting our One Credit, One Meal social initiative, through which we donate one meal to an unserved individual for every credit earned. By participating in this webinar, you are making your continuing education more meaningful, and we appreciate your commitment to this cause. Please note that as per regulations, you are required to remain logged into this session till the end and answer all the polling questions. An evaluation form will be sent to you within the next 24 hours after the completion of this webinar, provided you have answered all the polling questions. Well, this is an interactive webinar, and we encourage you to ask any questions you have in the questions panel, and we'll do our best to address them at the end of the webinar if time permits. Once again, thank you everyone for joining us today. And without any further ado, let's get started with our presenter. Let me introduce you to Henry Montag, the managing partner of the Tolley Center East, who's an expert in helping people understand their life insurance portfolio. They work with different advisors like CPA and attorneys and make sure that their clients' coverage is guaranteed for the lifetime, whether they own a policy individually or through a trust. They also educate people about how life insurance is now considered an asset class and can bring some living benefits along with the traditional death benefit for the beneficiary. So let's hear more from Henry about himself and his presentation. Thank you again, Henry, for being with us today. And without any further ado, the stage is all yours. Thank you.
Thank you, Jim. Thanks for the introduction. And shout out to MyCPE for putting this together, and also, most importantly, for their meals per each CE. I think that's a wonderful thing, and I know that's one of the things that attracted me to the organization. Thank you. I'd also like to thank our audience for joining us. We know that you have a choice of webinars nowadays, for CP or CLE or CE credits. So thank you for being here. My job as the managing partner for the Tolley Centuries, and by the way, Tolley stands for Trust-Owned Life Insurance, is to be able to act as a resource for professionals, accountants, attorneys, financial planners, financial advisors, other insurance people, CPAs, accountants, to just be able to act as a resource for any of their questions that they personally may have or that their clients may have regarding the subject, regarding the subject of life insurance, and of which, of course, the subject that we're going to be focusing on today happens to be a life insurance product. Many people think of an annuity as a life insurance product, but it is. So, who is the annuity marketplace? Who does it appeal to? Well, as you can appreciate, the insurance industry loves statistics. And although they may be 1 or 2 years behind the time, nonetheless, they do have most recent statistics from the year 2021. And as you can see, the average age is an individual in the late 60s. 1 billion was purchased in 2020 alone. Total, there's probably some in the vicinity of, at this point, I'm going to say close to $4 trillion of purchased various annuities out there to your consumers, to your clients. It's out there. And because of that, you should, of course, learn a little bit more about it. So I'm glad those people that are on this webinar have taken the time to do that. $3 trillion, $4 trillion. I can guarantee that some of your family members or that some of your clients absolutely own some of these various types of annuities we'll be talking about. It's right across the board. It's everything from professional to a foreman to a business owner to right across the board. Everyone has annuities. It's not just the old people. It's not just young people, as we'll find out in a little bit. One of the best benefits about an annuity is that it can be looked at as a personal pension plan. Somebody controls and that somebody has access to, and that there's no discrimination. There are no rules or regulations. You can put in as much as you want or as little as you want. So why do people buy annuities in the first place? Number one reason is because it is safe. It is guaranteed. The insurance industry in the United States is a very, very strong and thriving industry. Secondly, in my opinion, it's because of the fact that it allows individuals who put money in to do so and get a tax deferred basis during accumulation. Needless to say, professional management and making sure that one diversifies it is not too risky or is not too conservative is a very, very important aspect of annuities nowadays. And yes, professional management is in place. There are no income limitations. There are no limitations on deposits. If you make $1 million a year, if you make 100,000 or 10,000 a year, you can go ahead and take advantage of the tax deferred aspect of one of the various types of annuities. As I said, a wonderful way to supplement retirement. Most of us will receive some sort of Social Security. Or let me say, pretty much all of us will receive some sort of Social Security once we get to either age 66 or 70. But not everyone has some sort of a retirement plan. And certainly being able to take your own initiative, take your own retirement into your own hands, is a very, very important aspect. Being able to supplement your own retirement income is another one of the benefits. Basically, being able to diversify someone that might have a higher risk investment. And again, it's a good quality product and that most people have or will have in their portfolios. Excuse me. What's an annuity? An annuity is a specified income payable at a stated interval for a fixed period of time. Could be for, as we'll find out, for the recipient's life. It could be for a lump sum payment. It could be for an ongoing payment. It could be for a single payment, or it could be for a series of payments. The act of annuitization is being able to convert a deferred annuity to guaranteed lifetime income stream. Immediate annuity is something that's annuitized at issue. In other words, I can give an insurance company $10,000 or $100,000. I could say, go ahead and just let this grow for as long as I tell you to. It could be for a 5 year period, it could be a 2 year period. I will suggest that if it's under a 7 year period, there will be some form of surrender charges or penalties if one takes the money out too soon. But if one decides to annuitize an annuity, not a tax, it's not a tax consequence, tax incident. There are no consequences. On the other hand, somebody could go ahead and say to the insurance company, here's $100,000 and give me an annuity that doesn't accumulate. Give me an annuity that goes ahead and begins paying me a income right now. Issue. More on that later. What are some of the objectives of an annuity? Well, again, it's planning for the supplement retirement. It can help a person two different ways. If they're young enough, it can accumulate those assets on a tax-deferred basis. And then at some point, it can convert those retirement assets into income. And if you choose to, you can have a income that lasts life. As I say, a lifetime income that you can't outlive. Let me just take a quick moment and call Jim back in to just read out the first pop-up question. Who are annuities best suited for? Jim?
Thank you,
Jim?
Henry. All right, everyone. Here's the first polling question on your screens. Who are annuities best suited for? Please select your responses and hit the submit button to register your responses. All right. Thank you, everyone, for registering your responses. Thank you, Henry. It's over to you now.
Okay, very good. So let's talk about the different types of annuities. First one I'll mention in no particular order is a single premium immediate annuity. You go ahead and give the insurance company a number of dollars, tell them, I'd like to be paid out immediately. Well, later we'll look at the various types of payouts that you have. I can assure you that there are more payments, more types of payments than you could even think of. So I'll leave that for a moment. Right now, the bigger picture. There's a single premium deferred annuity, as I say, where you give the insurance company a lump sum of money and you tell them, let this continue to grow, and I'll tell you when I either want to take my money out or if and when I want to annuitize the single premium deferred annuity through you. Keep in mind, several hundred insurance companies, and just because your money might be accumulating at one a single premium deferred annuity, doesn't necessarily mean that you have to take that same company to perhaps annuitize your accumulated value at the end of 5, 10, 15, 20, 30 plus years. There's an FIA, a fixed index annuity. As it says, it's a fixed index on the interest rate declared by the company's directors or perhaps by the 2 year, 5 year, or 10 year. They go ahead and they pay out a fixed index and they go ahead and they pay that as long as you choose the annuity paid for. An indexed annuity can be tied into a ETF or it can be tied into a mutual fund. And whatever the index might return, you will get. Usually with an indexed annuity, you cannot lose money. There's a floor as to how much you might be able to, there's a floor as to how much you might be able to lose. So there's also a floor how much you might be able to gain. Those are called caps. With a variable annuity, there is no floor on the bottom, meaning that if the market goes up 10%, you will get 10%. If the market goes down 10%, you'll also lose 10%. Fixed index, guaranteed, no losses. Variable annuity, no caps on the upside. You can gain as much as you gain, but there are also no stops or floors, anything to prevent you from losing money on the downside. There's also something, as you learn a little bit later, the long-term care annuity allows an individual to convert an annuity and get advantageous tax consequences by using that annuity to either pay a premium for a long-term care contract or to be able to use those benefits to pay for long-term care costs. A longevity annuity is what it says. You might not begin receiving a payment immediately. Will begin receiving a payment perhaps in 4 years, 5 years, 7 years, 10 years, whatever you choose. That longevity annuity will start when you choose and continue to pay out a benefit for life. Let me just rush along a little bit because I see I'm getting a little bit of time. Okay. The four most common types of annuity are one, the immediate annuity, where an income stream starts, longevity annuity, where the income stream begins perhaps later or not at all, discretion. A variable annuity, where an individual is able to put money into the stock market, not necessarily into individual stocks, into a class of, or an arrangement, I should say, of stocks that may mimic various mutual funds, but they are an ability to earn a higher return, and the accumulation in that return, in that variable annuity, also grows tax deferred. The linked annuity is, as we'll see in a few moments, the ability of being able to gain advantageous tax benefits with an annuity if it's used to pay for long-term care costs. So let's take a look at some of the benefits of a deferred annuity as opposed to an immediate annuity. Deferred annuity, as we said, it has two distinct phases. It allows for an accumulation of savings, and then it has an income phase. Most important, most insurance companies would love for you to believe that you should stick with the same company that your money is growing in when it comes to an income, when it comes to taking an income stream. Not a good idea. A lot of insurance companies might bait you with paying a higher rate of return during the accumulation period because they know that that might encourage people to come in, and people oftentimes are a creature of convenience. Once the money is there and they can get a rate from that insurance company as to what they might be able to obtain on an ongoing income basis, many people are lazy and they're not going to shop around, and they might just go ahead and take the income from that same deferred annuity. Don't do that for yourself. Don't do that for your family. Don't do that for your clients. Shop around. I'll give you an example of that a bit later. Okay. On the other hand, we have the immediate annuity. That only has one phase, and that's the income phase. Again, there are several hundred insurance companies. Don't immediate annuity from your friend who may have said, I got a great deal, because that might have been 1, 2, 3, or more years ago. That may not be the same today. Got to shop around. Very large numbers. Anything. Back to that immediate annuity, opposed to not shopping around. Two types of deferred annuity. One, as I said, is based on a fixed interest rate, single premium deferred annuity, otherwise referred to as the SPDA. And there's the return based on index performance. Two are either the FIA, the fixed index annuity, or the VA, the variable annuity. Let's take a look at some of the how the returns are arranged or obtained in a fixed interest annuity versus an indexed annuity. Very simple. Fixed interest annuity, usually stated by the board or based on 2-year, 5-year, 10-year treasuries, whatever the insurance company might have chosen. Whereas the indexed annuity, as I say, is based on a series of either mutual funds or ETFs. And usually there's a cap on the upside return and there's a cap on the downside losses. Single premium deferred annuity, they do pay a minimum interest rate. Principal is guaranteed by the insurer. And if anyone's invested over the last year and a half, they can appreciate how important that guarantee by the insurer might be. Needless to say, many of us have seen clients or experienced losses 10, 15, 20, 29, 30+% losses year. Would have been nice to have received a guaranteed 2 or even 3%, or I should say 3 or even 2% return, as opposed to the losses. Current rates are determined by either directors or some form of, as I said, some sort of a treasury number. It's also the most popular type of an annuity is the single premium deferred annuity, and most people buy these for the tax deferred accumulation to supplement retirement. General obligation of the insurer. I'm not concerned about too many insurers going out of business. I can't say the same for, well, there are surrender charges. Usually it's a declining 7-year surrender charge. 7% first year, 6, 5, 4, 3, 2, and 1. Point is, if you're looking, or if your client or if your family member is looking to perhaps use this to either fund a education for their child or children, or buy a house, and they happen to be in their 30s and their kids may not be going to school for another 10 or 15 years, and they'll only be 40 or 45 when they first want to take the money out for a child's education, or they might be in their 30s or 40s. If they want to buy a house, this is not the right place for any type of a single premium or other type of annuity. As I say, there are surrender charges if the money is taken out. 7-year period, and there are taxes, federal taxes, if the money is taken out, and plus there's a 10% penalty. Just throw that in there as well. If the money is taken out before age 59 and a half. So this is not a place to park money temporarily. Long term, that's why I keep saying supplement. The single premium immediate annuity turns a capital contribution into a guaranteed lifetime stream of income for the annuitant. It's wonderful when interest rates are higher, as they are now, to lock in a current interest rate based on the current increases. There will be, as history will show, as statistics will show, more annuities, fixed, immediate, sold over the last year and perhaps going into the next year than there have been over the previous 5 or 6 or 7 or 8 plus years, not cumulatively, but in individual years, simply because rates are higher. And as people begin talking, rates perhaps no longer being increased, or perhaps at some point here, perhaps being decreased, makes for a very time to consider locking in higher interest rate. As I say, these single premium uh, immediate annuities are also known as private pension plans, because a business owner, an individual, employee, whoever the case may be, can put away the money for themselves, only for themselves. Might not be the best treatment on these, but that's why they're as liberal as they are. And go ahead and lock in money that can be used later down the road. What's some of the biggest mistakes that people make in retirement? I put together a packet of handouts. Um, One or two of them are kind of old because I've been using these for years, and I should update. And this webinar made me realize that I should write another article on that topic. By all means, take a look at the handouts. And let me give you an example. Taking the company payout without shopping is one of the biggest mistakes at retirement. Why? Because it may not be competitive. They may have sucked you in. I shouldn't say suck you in, because the insurance company that your employer may have contracted with had a strong initial payout. And as I say, recognizing that most people will stay where they are. So I had a client who received that letter from the insurance company, that packet, congratulations, separation of service, and for their money that they had in their 401 or in you know, their profit sharing plan, or you can call it any type of accumulation vehicle that you want to, they were receiving a monthly payout of $6,500 a month. Fortunately, their accountant said, before you sign this, because once you sign this, it's you can't change it. So be careful before you sign it. Why don't you go see Henry and see if there might be something else that you might suggest instead of taking the separation from service papers to you by your employer? Well, sure enough, we looked at his initial lump sum, and I knew what his existing company was paying, approximately 6,500 a month. And I took that lump sum and I went to various other insurance companies, single premium immediate annuities, because that's all his company was offering. Their single premium immediate annuity, the insurance company that was used to accumulate that annuity while he was in service. Well, needless to say, I was able to come up with another A-plus rated company, and being paid $6,500, it was closer to $7,200. If you do the math, that's about an 8% increase for the rest of his life, just because he's smart enough to go out and see what else is out there rather than just signing the separation papers from his existing company. Their job is not to get you the best. Their job is to sign the papers and separate you from service. Getting the best payout, that's your job. Your own 401 or 403 or whatever you happen, whatever you may be asked for advice regarding what should I do, family member or from a client. Okay. Before I mention that there are going to be certain examples of annuity, these are called settlement options. You can have a settlement option that will pay you a income for the rest of your life, whether you live to another 10 years, whether you live another 30 years, whether you live another 40 or 50. Also, a life only with a 10-year certain, meaning if you annuitize today and you don't feel good about, well, what happens if something happens to me tomorrow or next month or next year? You also have a life only with a 10-year period certain. When you have a guarantee of some sort, it's going to pay less than when you're willing to would with a life only, joint life and survivor. You can go ahead and provide uh, payment for your life, and then your spouse, whoever he or she may be, will receive a 50% survivor benefit. You can do the same thing where you can have it go over 2 lives. You will get X number of dollars, and your spouse will receive the same amount of dollars. Insurance company is not stupid. You're going to get much less if you want 100% survivor benefit than if you only want a 50% survivor. Then you can make all sorts of other imaginations with joint life, 50% survivor with a 10-year certain, or joint life with a 100% survivor and a 10-year certain. You can get a lot more money just by saying, I want to be paid out over a 5-year period, over a 10-year period. So the choices are yours. Let me just take a quick break for a moment and just see if there are any questions that need to be addressed right now before the Q&A at the end of the session. Jim, if you're there, please, if you just let me know if there are any questions that need to be addressed right now.
Sure, Henry. Let me check. Okay. Nope, we do not have any questions from any of our attendees, not in the chat panel. Wait, we got one. Uh, the question is, what are typical initial fees, commissions?
What are the typical fees and commissions? Okay, let me address that first by talking about the fees, and then I'll talk about the commissions. If somebody buys $100,000 single premium deferred annuity, and at the end of and if the I'm making up a simple number, these don't exist. If somebody is has a guarantee 5% return at the end of exactly 1 year, that $100,000 will grow exactly into $105,000. 5% guarantee. That looks like there are no fees, and it looks like there are no commissions. Your net return is 5%. That's your turn, 5%. On the other hand, the insurance company builds in their own fees, builds in their own commissions paid to the broker or agent. But those fees and commissions are net of what the individual received. I hope that answered your question. Any other question, or did I answer your question?
Nope, that's all for now. We can
Okay.
continue with the session.
Again, we'll have some time for questions, and again, use me as a resource. Now, there got to be questions that people have, because this is not a difficult subject. It's There are many options and there are many moving parts. So please use this as a resource. And I know some of you, will typically call me after this is over or email me after this is over, and I'll be happy to take your questions that way as well. Point is, I'm here as a resource. Okay, taxation of annuity withdrawals. Very simple. Last in, first out. It gives you some wonderful tax deferred accumulation benefits, but this is not a tax play long term. It's a tax play during the accumulation period. So if you put in $100,000 at the end of 59 and a half, whatever it is, you decide I want to take out that 50,000 that grew to $100,000. You want to take out that initial $50,000. That's all going to be You must exhaust all the interest taxable before getting to the principal, with the exception of a linked annuity, which I will talk about in moments. Uh, it's just time for another pop-up question. So, Jim, if you're available, please take that.
Thank you, Henry. All right, here's the second polling question on your screens. What's prime reason people buy annuities? Please select your responses and hit the submit button to register your responses. Thank you.
Okay, I think we can move on from that.
Yep. Thank you everyone for registering the responses. Thank you, Henry. It's back to you.
Okay, so just talk about a different type of an annuity for a moment, because everything that I've mentioned up until now has been basically speaking of a single premium deferred annuity, which is a fixed annuity, variable annuity. A variable annuity is an annuity that doesn't pay a fixed return, but the return is variable on the returns of either, I'm going to say the stock market, it's not the exact mutual fund. If you invest in, say, the Fidelity Contrarian Fund, and you use that as one of the choices in the variable annuity, you're not necessarily going to invest in the Fidelity Contrarian Fund, but you will be investing in a clone of the Fidelity mutual fund. So I need to just make that definition that it's not the mutual fund, but it's a clone of the mutual fund. Variable annuities usually have high fees. They usually have M&E, mortality and expense costs, and they usually have commissions. Those fees, those M&E costs, those commissions do affect your return in a variable annuity. The fees can be whatever mutual fund company might charge that actually does the management. And as I say, it's not the mutual fund company, one of that mutual fund company, as somebody making decisions, making choices of which uh, funds or which ETFs or which individual companies to sell or hold, and they have to get paid. And that is a cost that comes out of the variable annuity. The insurance company has to get paid. That's the mortality and expense. But they give you something for that. Say somebody starts out with $100,000, and 10 years down the road, I'm making up a number, it's now worth $250,000. Following year, it might drop back down to $200,000. The mortality and expense costs usually lock in the highest watermark. So in that situation that I just gave, start out with $100,000, it grows to 250, then it drops down to 200. The annuitant way variable annuity is now at 200. The mortality and expense costs locked in when the uh, accumulated value was 250,000. So it is a form of insurance. It's also how the insurance company makes some of their fees. Yes, there are commissions, and the commissions can be as high as 5, 6, 7% for selling or for purchasing a variable annuity. And those costs and fees out, unlike the single premium deferred annuity, they come out of the return. Net return is 10% for the year, but the insurance company has, I'm making these numbers up, the insurance company has a 1% mortality and expense cost, and the fees are 50 basis points. That 10% is going to be reduced by the M&E of 1%, by the fees of 50%. So that 10% return is now an 8.50% return. The variable annuity does grow and accumulate. It's guaranteed, and it can lose principal. Withdraws it true for all annuities, whether it's a fixed, variable, single premium, immediate, but not say immediate tax treatment. Own. Any of the others that I just mentioned, all the others that I just mentioned, now before age 59 and a half, there's an IRS penalty of tax on all the gains, plus a 10% penalty. And if you do that in a 7-year period, again, there's going to be first year declining to 6, 5, 4, 3, 2, and 1. These are good places to accumulate money, but not a good place to keep money, as I say, if you're using it for age 59 and a half, or if you're going to be taking money out, um, if you're going to be withdrawing that money for some period of time shorter than the 7-year period. Immediate annuity, once you sign the insurance company, once you annuitize, that's an irreversible decision. So once you annuitize, there are no penalties. You just can't undo it. Keep in mind, you sign those papers and you annuitize any of these annuities, and any of these annuities can be annuitized, as I say, with the existing company or with one of the many other companies that you should for. Mind, buying a annuitizing, irreversible. You can change your mind next week, next month, next year. No penalties. It can't be. Buffered index annuity. This is really different and unique. Imagine, if you will, being offered investment that protects you against the first 10% of losses, or perhaps 20%, or perhaps 30% of losses, in exchange for all gains over a set percentage of Nasdaq 100, of the S&P, of the Russell, or of any sort of an international mixture of various investments. Put that into example. Imagine if you were offered the opportunity, $100,000, and have the first 10% or 20% losses wiped out, and all you have to do is be willing to give up all gains over, and here's a real number for the month of April. I don't know what the numbers are going to be for the month of May, but would you be willing to protect 10 or 20% losses in exchange for all gains over 20% of the Nasdaq 100? In other words, the market is up 10%, you keep it all. If the market is up 15%, you keep it all. If the market is up 20%, you keep it all. If the market is up 25%, you keep 20, the insurance company keeps. That's the choice that your clients had to make, and people are aware of it. Despite that, just 2 weeks ago, one of the major companies that just did their billionth dollar, millionth, obviously, their billionth dollar, these buffered index annuity strategies out there. They're very popular. People are aware of them, but now you're aware of them. It's an excellent way to diversify into a new asset class that offers protection of principal while maintaining an opportunity to participate in a healthy percentage of market gains. Most people that I discuss this product with, they assume that the set percentage that I mentioned a moment ago is going to be 7 or 8 or 10%. It's been in the range of 22, 21, 20% for the last 7 months. So, something for you to be aware of. You are now aware of it. What are some of the advantages and disadvantages of any type of an annuity? As we said, they're tax deferred as long as they remain in the annuity. When you take it out of the annuity, they're taxable. But when you compare it with a taxable investment, one is far better off being, and that tax deferral over the accumulation makes a great deal of sense. Another advantage is that it provides a guaranteed source of income you can't outlive. Usually, insurance companies don't go out of business. Usually, I'll I can say that more than just usually. Companies are strong financial institution, and for the most part, if life insurance companies, they don't go out of business. And unlike an IRA or an employer-sponsored plan, there are no annual. Um, you can use those numbers for yourself and just realize they are a good idea. And I strongly suggest that an annuity is something that you diversify your as well as a client or family member with. What are some of the disadvantages? They're not tax deductible. They're made with dollars. Can surrender before receiving income payment. Charges, as I said, going to be 7 years or 5 years, declining for 10 years. The individual made prior to age 59, there's a surrender charge. There's also a 10% penalty. The investments are basically taxed and they're not taxed favorably. You know, they're a good place to accumulate money, but not a good place to distribute money from. Oh, look at that. Good place to accumulate money, but not a good vehicle to death. Okay, so let's talk about another option regarding movies. Several years ago, there was a act, Protection Act, which in 2010, and the insurance industry first began offering strategies and products in 2012. So it's 10, 11 years old. But again, I'll bet you if I did a polling question right now and said how many people are aware of the Protection Act, that less than half of you would say yes, and the other half would say yeah, no idea what it is. So let me take a moment and talk about it because one part of the Pension Protection Act does enhance and does be subject of. So, Pension Protection Act was designed to make it less costly for individuals to purchase long-term care insurance. One, because it was a partnership between the federal government and the insurance companies in various states. And guess what? If people purchase their own long-term care insurance, then the federal government would have less people to pay for through Medicaid if and when they need some form of long-term care facility or at home. And the insurance company likes to sell long-term care insurance. So what they did is they combined long-term care insurance and life insurance. So imagine somebody buying $1 million life insurance policy today, and next week, next month, or next year, that same person now needs long-term care. An individual can now begin withdrawing not from the cash value, which is non-existent in the first year of the life insurance policy, but now can withdraw from the $1 million death benefit to pay for long-term care costs out of the death benefit. Boot, it's tax-free. The withdrawals are tax-free. So somebody buys $1 million life insurance policy, long-term care, first year, second year, third year, they're able to withdraw that 100,000 from the death benefit and not have to pay taxes on it. Naturally, if they withdraw $100,000 from that $1 million life insurance policy at death, their beneficiaries will only receive 900,000. And if they do this for a number of years, the death proceeds for the beneficiaries will, of course, decrease. But this is what I call a living benefit. And this living benefit came about as a result of the Pension Protection Act. It created favorable taxation for transfers. It created favorable taxation for long-term care insurance. I'll see in the next one or two slides. And it also created favorable tax treatment for single premium immediate annuities. We'll talk about in the next moment. Okay, I'm going to skip over this. This is a little bit too technical, and I'm watching my time, and I want to leave enough time for questions. So there are two types of riders. One is known as an LTC rider, and the other is known as a chronic care rider. They're different. I'm not going to get into it at this moment. But basically, you can withdraw up to $5,000 tax-free annually, a combo life with an LTC chronic care rider or with an LTC rider for long-term care costs. This was done to encourage people to rely on the Medicaid system, encourage people to buy long-term care insurance. And as I say, buying life insurance, long-term care rider or a long-term either called an LTCI rider or called a care rider, something new, something wonderful, and a great way to encourage people to buy long-term care insurance and not have to rely on the federal government and the state government. Okay, just look over to the right side. You can now, well, let's
Um,
start at the left side.
I'm sorry, Henry, to interrupt you in between, but we
Yep,
do have one question from
sure.
one of our attendees. So the question is, how are distributions taxed? Are they capital gains or ordinary income?
Ordinary income. Ordinary income. When gains are taken out, the as I said before, the benefits are not to distribute. Benefits in an annuity are to accumulate. So it's not long term. It's not capital gains. It's not long term. It's ordinary income.
Thank you, Henry.
Okay, so under the long term care and annuities under the PPA, if you look over at the left side where it says old 1035 rules, the 1035 rules are tax free exchanges. You could transfer an annuity to an annuity. You could transfer life insurance to life insurance. You could transfer life insurance to an annuity. If you look over at the right side, after the PPA, the new 1035 exchange rules allow you to take an annuity, transfer it into long-term care insurance without paying any taxes. 35 rules. It's okay to transfer cash value from life insurance to an annuity, but you can't transfer an annuity to life insurance, but you can transfer an annuity's gains into paying for long-term care costs in two ways. The first way I'll talk about is single premium immediate. If you look up on top, it says before 2010 with a single premium immediate annuity, you would first have to pay the taxes before you could get out 100% of your money. Compliments of the Pension Protection Act now take 100% of the gains and use that to pay a long-term care insurance premium. So you're avoiding the taxes if you have the single premium immediate annuity payment. Instead of going to you, go directly to the insurance company. They're able to do this because of the exclusionary ratio that they pass on to you by merely paying the immediate annuity income directly to the insurance way to for the federal government and the insurance companies to encourage people to buy some form of insurance. What's the significance? Oh, I'm sorry, Jim. Why don't you go ahead?
Thank you, Henry. All right, here's the third and the last polling question. What significant Pension Act, Pension Protection Act? Please select your responses and hit the submit button to register your responses. Thank you.
And let me know whenever you're ready.
Thank you for registering your responses. Thank you, Henry. It's over to you now.
Okay, so this is not about protecting everyone's pension, not about pensions being able to be rolled over. The main significant points of the Pension Protection Act is that the death benefit can be used to pay for long-term care. Okay, change to the 1035 rules. It allows for tax-free exchange from one policy to another. It allows for partial transfers. It allows annuity to go to LTC, to go to an LTC buy long-term care insurance policy tax-free, and it also allows the income from a annuity to be paid to an insurance company for the premiums for long-term care also tax-free. By the way, this only applies to non-qualified money, apply to any sort of pension, to any sort of 403, 401, profit sharing plan, defined contribution, defined benefit, none of those. It's only for non-qualified money. So, summary of the linked benefits on annuities. Say SPIA can be used to pay for insurance tax-free. A deferred annuity can be converted to a linked annuity, to a combo, or just tax-free benefit. Bottom line is it increases the available lump sum available to pay for long-term care expenses. It pays for a small interest rate, but it maximizes the long-term care insurance funds. And it's a perfect strategy for any type of an interest rate environment. Everyone wants long-term care insurance. People just don't want to pay for the premium. So just a side note, long-term care insurance is I've been in this business since 1984, and I have a significant number of people claim. And I'll tell you, the phone calls, the notes, the emails that I get, just saying thanks, thanks for that I do this. Thanks for forcing my mom and dad to do this because the long-term care insurance is not just for the individual, although it does provide significant amounts of privacy, dignity, dependence to the individual who needs the care, but it also frees up the son, daughter, husband, wife, children, grandchildren from having to. It's one thing to care about someone, it's another thing to care for them. Long-term care insurance does something for both the individual needing the care and the individuals providing the care. An example of how this might work, start out with $100,000. That can buy $159,000 of death benefit. Use these annuities don't use it for the death benefit. They use it to maximize the $100,000 and turn it into a 5-time benefit for care for an individual for care. And this is the numbers for a 68-year-old. Life insurance has 2 funding options. You can use mutual funds, you can use life insurance. Both provide for accumulation on a tax-deferred basis, but only life insurance can be distributed tax-free. A series of surrenders and loans never have to be paid back. I say that again. Life insurance can not only accumulate assets tax-deferred while they're being accumulated, but if it's set up correctly, insurance can also be distributed income tax-free through a series of loans and surrenders. It's like a Roth IRA on steroids. You're getting the benefit on both ends, the tax deferral and the tax-free distributions. And if anyone has any questions on this, back to summary features. It provides it makes annuities a more favorable. The Pension Protection Act makes annuities a more favorable type of expenditure. Let me not say expenditure. It makes annuities a more favorable place to accumulate because of the long-term care rider tail end at the end. You've got to match, clients' risks with their desired outcomes, whether you want a fixed, whether you want an index, whether you want a variable. Uh, Not doing so can really lead to an amount of unnecessary risk on the part of the client and a certain percentage of underperformance in the event that the client is too conservative. Point is, all insurance policies must be reviewed for their current relevancy and for the best use strategy. Rather than getting into this combination of using an annuity and life insurance maximum benefit, let me just leave a couple of moments for questions because I see it's 3:55 minutes. is annuities must be reviewed. Interest rates change, ratings change, new benefits become available. People have to understand that their beneficiary designations, they change. Can't tell you how many times, individuals neglect to update their beneficiary designations. And then when the time comes to it, a divorce decree does not supersede or does not override a beneficiary designation just because you're divorced or anything. Having a valid will uh, is good for the items in the will. Fine. Life insurance does not go through probate. Life insurance has a beneficiary designation. And because it has a beneficiary designation, doesn't matter what the will says, doesn't matter what the divorce decree says. Your beneficiary designation in your life insurance policy get the money. Life insurance is a great place to transfer assets prior to death because, as I say, annuities are wonderful places to accumulate tax deferred, but they get walloped, um, both from a tax point of view, federal estate tax point of view, earnings point of view. Um, but if you transfer that income tax point of view, as the individual before asked the question, what are the treatments when money from an annuity is distributed? So a good suggestion is to think of combining that annuity for its accumulation period and then it in the direction of a life insurance to be able to get the death benefits and get the tax benefits, the tax with a life insurance policy at death. As I say, annuities. There are so many different tax aspects of an annuity that I could do a whole session on that alone. So I have the information here and a slide. And for those of you that are interested, simply download the entire presentation as well as the handouts and go through. And again, as I say, use me as a resource once that come up. Well, I have 3 minutes left for questions. Sorry about that. But again, here's my contact information. I do suggest that you look at the handouts. There's some wonderful information in there. And Jim, in the last 3 minutes, I'd like to open it up for any. Jim,
Yeah, thank you, Andre. Uh, let's see. All right, everyone. Now we'll allow you to ask live Q&A. So, ladies and gentlemen, please click on raise hand if you have any questions, and we will allow you to speak up for any live Q&A. We kindly request you that you limit your questions to a maximum of 1 minute to ensure that we have time for everyone to participate. So please click on raise hand and I'll just go ahead and unmute them so that they can go ahead and ask the presenter the live question. Okay, I don't see any responses.
okay. Then let me just end with this slide.
Sure.
This is a male 76, $1,000 in a taxable CD earning 4%. He was earning about $15,000 a year. Fortunately, his accountant said, Henry, show this individual what else might be done. Real fast. Had him use $228,000 to purchase a single premium immediate annuity, threw off $26,000. This is an individual. His 15,000 turned to 26,000. Son said to me, well, yeah, okay, that's great. You just increased my dad's income, but I just lost 228,000 because you told me before that once my dad signs these papers, that immediate annuity is gone. All I've got left is 372,000. I said, yeah. And you know what we're going to do with that 372,000? We're going to buy another single premium deferred, single premium immediate annuity, and that is going to purchase 33,000. And guess what we're going to do with that $33,000? We're going to use that to purchase $1,000 of life insurance. Oh, so you mean when my dad dies, I'll get that $600,000 of life insurance? And you mean while my dad's alive, instead of him getting the 2.5% yield of 15,000, you just increased his income $11,000 to $26,000? I said, where do I sign? So I'm just pointing out that there's a there are many strategies using uh, the buffered index strategy to be able to protect against the first 10% or 20% of losses in exchange for giving up income over for giving up returns rather gains over 20% of the Nasdaq 100. That's an interesting strategy. Combining life insurance with single premium immediate annuity makes sense. Shopping, yeah, all these things make sense. Time is up. Use me as a resource. It's been a pleasure. Jim, thank you. And again, thank my CPE for being here and allowing the information to be spewed out. I'm available for any questions by email, and I look forward to hearing from you. And Jim, it's right back to you.
Thank you, Henry. Thank you so much. And let's see for the questions if we have any. Nope. So I think we are good to wrap up this session. Any last words for our attendees?
I know I've said it before. I don't want to sound like a broken record, but there are going to be questions, and I've done this before. There are going to be questions afterwards, and I welcome those questions. I'll be more than happy to talk privately by email or talk privately on the phone, whether it's today, next week. Use me as a resource.
Great.
I'm a CFP. I should mention I'm a CFP, so I do have a fiduciary obligation to do what's in the client's interest, but I've been doing this long enough to know that the rules don't mean anything. I do what's in the client's best interest, not because it's a rule or law. I do that because that's what my dad taught me many years ago. It's the
Great.
right thing to do. Okay. With that, thank you, and I look forward to hearing from you.
Thank you, Henry. Thank you so much. Thank you so much, everyone, for joining us today for our webinar on MyCPE. I hope you found this session informative and engaging, and I would like to extend a special thank you to our presenter, Henry, for sharing his expertise and insights with us. Henry
Thank
has
you.
been one of our best presenters, and we are always thrilled to have him on our platform. Thank you again, Henry, for this wonderful session.
Thank you, Jim. Thank you.
Thank you. One more important thing, everyone, to obtain your credit certificates, you will receive an evaluation form within the next 24 hours after the completion of this webinar, provided you have answered all the polling questions. If you have any further questions or if you need to view the recording of this webinar, please feel free to email us at support@my-cpe.com. We would love to hear your thoughts on today's webinar, and it would be really appreciated if you record a brief video testimonial in the evaluation form to let us know how we did. Once again, thank you so much for being such a wonderful audience. We appreciate your participation and hope you will join us again for future webinars. Take care of yourselves and your loved ones. Stay safe, stay healthy. Have a great day ahead. Thank you. Thank you,
Thank
Henry.
you.
Have a great
Bye,
day.
Jim.
Bye.
Thank you.